let's deal with what we know. How about that? Tariffs are on. The economic data continues to weaken a bit. ADP missed badly. We've had a bear steepening in the yield curve. The front end falling on rate cut expectations. The long end is rising. The S&P down about 3% this week. When will this market stabilize? What has to happen here?
Well, if you're looking at domestic equities, you're hoping to find leadership somewhere. And I've said over the last week that I do not believe the market is close to finding that leadership. The momentum names that everyone keeps identifying, they are not going to have a V-shaped recovery. Capital right now is flowing out of the U.S. very clearly. It's flowing into Europe. Germany is incredibly strong right now. They're experiencing some economic growth. You're seeing strong flows of capital going into the taxable fixed income market. Let's remember something. We came into 2025 with very bearish positioning as it relates to treasuries. All the trend following funds were basically caught offside, expecting a 5% 10-year treasury. That is being unwound as we speak now. And I also think that's affecting what's going on in the market. Looking at equities themselves, thinking about the Mag 7, thinking about quality, thinking about bond proxies. Where can you find that next leadership? That's what we are trying to determine. And we also have this technical orientation where the 200-day moving average is very close to current price. It was there yesterday. We bounced. We had a sharp bounce off the 200-day. It looks as though we want a second test to see what the reaction is going to be to buyers get incentivized at that point.
All right. So, Kerry, I mentioned we are going to be headline driven. There's a headline I'm looking at now that says the U.S. is weighing a 1-month delay of Canada and Mexico tariffs on autos. I don't know if that's why the market looks like that, where there was a bit of a move higher. But we're going to be pushed and pulled by a lot of the headlines that could come out of D.C. So how are our viewers supposed to navigate all of that when Wolf Research today says the rally is poised to make a stand? We're oversold, but still more pain could be ahead because we didn't really have a big flush. We didn't have a big panic in the market. We've just had a tariff-driven and growth scare-driven slowdown.
Right. So what a surprise. We might delay the tariffs. This is what we should expect. And investors should understand that what is said is different from what is going to be implemented. Therefore, you have to just judge how serious you want to take these moves. What we saw with tariffs.
Like this right here, right?
Correct.
General Motors, obviously moving on the headline.
Correct.
Ford is, you could pull Stellantis, the obvious places. If you're talking specifically about autos, you're going to get the movements there. But to your point, and it's well made, we're going to be driven all over the place, right? What is today might not be tomorrow. What is today might not be the same in 10 minutes.
So if you look at what industries can persist and sustain their growth, regardless of what the headlines say every day. And I think that's an important determination of where to look to invest. We know, we have heard, and we believe it, that the spending on chips and on AI development is going to continue this year and next year. Companies have made that very clear. And these big buyers, the biggest companies in the world, Microsoft, Apple, Meta, Google, are spending the money, Amazon. So you can believe that these are going to continue. And if you want to place bets on a group that has fallen, that's a place to put some money. If you want to just trade, it's better for financials today than it was yesterday, it's better for consumer today or tomorrow, I think that's a mistake because there's weakness, there's uncertainty, there's deal postponement, and we understand that's going to continue.
There seems to be, Weiss, an expectation, too, that no matter how you get driven by one headline and then driven by the next, that as long as the president and his team are talking about, April reciprocal tariffs, remember that report on reciprocal tariffs is supposed to be coming due April 1st or the 2nd or whatever it is. JP Morgan's trading desk says that we're only at the beginning of Trade War 2.0. And with that study coming, you could see blanket tariffs. They say we expect this portion of the trade war to last until at least mid-April. My question then to you is, does that mean that we just remain unsettled until at least mid-April?
The answer is, in a word, yes, at least April, and I think longer than that. So to Carrie's point, there are headlines coming out. Which way do you go? Which headline do you buy into? Some people say just ignore the noise. But here's why you can't ignore the noise. Because the noise is so loud and things are moving so quickly and there's no strategy behind the noise that it's very destabilizing for corporate America. Now, take it one step further. I can tell you that of a number of people we talk to, boards that I sit on, across industries, not just defense, not just healthcare, but other industries as well, that everybody in government has their resume out. And again, it reminds me when I took over Lehman. The top performers that could leave, did leave when it was a mess, when it was $500 million revenue, losing money hand over fist. So you had to restaff. Except at Lehman, we had the balance sheet from, thank God for fixed income, to do that. There is no balance sheet here for the federal government because the pay grades are the same. So you will lose the top people. What does that mean when you drill down? It means the relationships that corporate sales teams had with the procurement officers up and down the government, they may be lost. So you may have to rebuild those. So not knowing if your critical counterpart in the government is going to be there, not knowing what the tariffs are going to be, you pretty much grind spending to a halt.
Well, because, I understand the uncertainty of CEOs in corporate America. The stagflation word's been introduced. Leisman's been talking about that. There was another article about it today. Ed Yardeni mentions that it could have a stagflationary consequence. And by the way, he's about as bullish as they've been.
And I mentioned last week stagflation.
It's the word of the moment because people just don't know what's going to happen. Bank of America talks about the tariffs and says a realistic bad case is a 10% hit to earnings. You just don't know.
They don't know.
They don't know. No one knows.
Right. But to me, I think it's pretty obvious that the direction in earnings is going to be lower. But it's not just CEOs. It's also individuals. You saw it in the jobs today. Who's going to hire, number one? Number two, who's going to spend not knowing if you're going to lose your job? So the amount of uncertainty created by this. And then for the stagflation, so that takes care of the slowing. For the inflationary, sure, the situation with open borders had to be taken care of. Had to be. But that's inflationary. So you lose those people, right? And you'll have to pay up for the scarcity of people that are here that can work, number one. Number two, tariffs are going to raise prices. So you can take a look at the headline Ford, and I don't think it's a positive thing he goes back and forth. That just means it's more uncertainty. So I'm still negative on the market. I do think the market is oversold for right now and could pop. But overall, I'm not putting cash to work.